You're staring at the open enrollment portal after lunch. Same blue buttons. Same confusing plan names. You click default because your actual work is screaming. That click may be the most expensive 5 minutes of your year. Open enrollment is not paperwork. It is compensation with a boring costume. Maya learned this at a 700-person software company. UX researcher, salary $112,000, smart with money, completely asleep at benefits time. For 3 years, she auto-renewed the PPO. It felt safe. It felt adult. It also quietly ate her raise before it landed. Then her manager said raises might be tight. Maya stopped waiting for permission and opened the benefits portal like a pay stub. Here is the cheat code. Consider calculating total annual value before you choose. Premiums, deductibles, employer money, tax treatment, and benefits you never claimed. Beat salary is the headline. Benefits are the footnotes where companies hide real dollars, and footnotes can pay rent. Start with the health plan. Don't compare monthly premium alone. One approach is comparing annual premium plus expected care plus realistic emergency risk minus employer contributions. KFF reported average annual premiums for employer family coverage hit $26,993 in 2025, with workers contributing $6,850 on average. Translation: your health plan is already a 5-figure compensation object. Your share is just the visible slice sitting on your paycheck. KFF also found covered workers with single coverage in a general annual deductible averaged $1,886 costs during 2025. Maya pulled 3 numbers: her payroll premium, deductible, and out-of-pocket maximum. Then she estimated normal care, therapy, prescriptions, annual visits. Consider using last year's claims as a rough starting point. If your health changed, update the estimate. If you're unsure, consult a benefits specialist. The mistake is picking the cheapest premium and pretending the deductible doesn't exist. Cheap can be smart. Cheap can also be delayed pain. Maya's PPO cost more every paycheck. The high deductible plan cost less, included employer HSA money, but exposed her to bigger upfront bills. She didn't ask, which plan is best? She asked, which plan fits my likely care, cash cushion, and worst-case tolerance? That question matters. If one surprise bill would wreck your month, consider valuing predictability more than theoretical savings. If you have chronic care, planned surgery, pregnancy, or expensive prescriptions, consider running scenarios carefully before changing plans. Talk with your clinician when needed. If you're healthy and keep emergency cash, a high-deductible plan with HSA support may help, but only if the risk actually fits your life. Now the HSA, this is where many employees leave real money on the table because the word account sounds optional. For 2026, the IRS set HSA contribution limits at $4,400 for self-only high-deductible coverage and $8,750 for family coverage. Lower voice, those limits matter because an HSA can work like a tax-advantaged medical reserve, not just a debit card for co-pays. IRS Publication 96969 says eligible HSA contributions may be deductible or excluded from income. Earnings may grow tax-free, and qualified medical distributions may be tax-free. One approach, if eligible, consider contributing at least enough to capture every employer HSA dollar. Employer contributions are compensation, not kindness. Maya's employer offered $900 in HSA money. She had ignored it because the plan sounded risky. $900 is not a brochure. It is cash value. She compared the PPO premium gap with the employer HSA deposit. Then she added potential tax savings based on her marginal bracket. Consider asking payroll whether HSA contributions run through cafeteria plan payroll deductions. That may reduce federal income tax and payroll taxes depending on your situation. This is not tax advice. HSAs have eligibility rules, qualified expense rules, and state quirks. When the dollars get large, consult a tax professional. Next, FSA. The flexible spending account is less sexy than an HSA because it usually does not roll forever. But an FSA may help if you know predictable costs are coming: orthodontics, therapy copays, contacts, prescriptions, or planned procedures. Consider estimating only expenses you are reasonably confident about. The FSA can save taxes, but unused funds may be limited by plan rules. Maya skipped the FSA every year. Then she realized her therapy co-pays alone were predictable enough to justify a conservative election. The cheat code is not maxing every account blindly. The cheat code is matching the account to known expenses and your tolerance for lockup. Now pulls student loans into the picture. Most people treat loans as personal baggage. Some employers treat them as a benefit category. IRS guidance says employees may exclude up to $5,250 of qualifying educational assistance benefits from gross income in 2025 and 2026, including certain student loan payments. BLS reported student loan repayment benefits were available to 7% of civilian workers in March 2025 and 22% of hospital workers. That means the benefit is uncommon, not imaginary. If you're interviewing, consider asking directly before assuming the answer is no. Use this exact phrase. Does the company offer Section 127 education assistance or student loan repayment, and what is the annual cap? Ask after they like you, not before you've proved fit. Best moment, recruiter screen after compensation range, or offer stage benefits review. Maya asked HR and found tuition reimbursement for job-related courses. She had been paying for analytics certification herself. Small laugh. Same course, different payer. That is the kind of career math nobody celebrates on LinkedIn. If education assistance exists, consider checking eligible programs, grade requirements, repayment clauses, and deadlines before enrolling. The trap is assuming reimbursement means automatic. Treat PTO as compensation too. A job paying $5,000 more but offering 10 fewer days may not be richer. Retirement match belongs in the scorecard. Disability insurance belongs there. Commuter benefits, childcare support, legal plans, and mental health coverage may matter too. But do not make the scorecard complicated. One page. Base salary, bonus, health cost, employer HSA, retirement match, education money, loan help, PTO. When Maya compared her current package, the health plan switch plus HSA capture was worth roughly $1,600 in expected annual value. Add the certification reimbursement, she stopped self-funding, and her benefits math looked like a raise she never negotiated. Notice what didn't happen. She didn't work nights, she didn't beg for praise, she stopped letting the default button negotiate against her. Your move today: download the benefits guide, last year's pay stub deductions, and your claims history. Consider putting them beside one blank page. Consider making 3 columns: premium, like we care, worst case. If the worst case scares you, do not ignore that signal. For prescriptions, consider checking plan formularies and pharmacy tiers before choosing. A cheap plan can become expensive one refill at a time. For dependents, consider each person's real usage. The family plan math changes fast when one person has specialists or recurring medication. For couples, compare both employers' plans. One partner's benefits may beat the other's even when the salary story says otherwise. If you changed jobs, moved states, got married, had a child, received a diagnosis, or paid off debt, do not auto-renew. Your old default was built for your old life. Benefits elections should follow the life you actually have now. For job offers, ask for the full benefits summary before you negotiate final compensation. Base salary without benefits is an incomplete number. If they will not share details, consider that a signal. Serious employers can explain the value of what they claim is generous. Exhale. Consider saying, the base works, but the benefits package leaves about $4,000 uncovered for me. Then try a concrete ask. Could we adjust base to $118,000 or add a signing bonus to offset first-year benefit costs? You're not being needy. You're pricing the offer. Companies do this to you constantly. You can do it back. Quick safety check. Do not skip medical care to make a spreadsheet look good. The cheapest plan is not worth harming your health. Consider an emergency buffer before choosing high-deductible exposure. Cash flow matters. A mathematically optimal plan can still fail a real person. If this helps you catch one expensive default, consider liking or subscribing. No pressure. Just keep the cheat codes within reach. Here is Maya's final system. 30 minutes. 1 page. No finance degree. She named the dollars hiding behind every checkbox. First, she totaled annual premiums from payroll deductions. Monthly numbers feel small. Annual numbers tell the truth. Second, she estimated normal care and prescriptions, not fantasy. Last year's real receipts, adjusted for what she knew was coming. Third, she added downside risk, deductible, out-of-pocket maximum, and whether she could cover a bad month without debt. Fourth, she subtracted employer money, HSA contributions, wellness credits, reimbursement dollars, and any education or loan payments she could actually use. Fifth, she added tax treatment carefully. HSA, FSA, and education benefits may reduce taxable income, but rules matter. When uncertain, ask a professional. The result was not perfect, it was better than guessing, and in career money, better than guessing is often worth thousands. So before you click default, pause. That portal is not admin work. It is a compensation negotiation with checkboxes. The recap: compare total cost, capture employer dollars, use tax-advantaged accounts carefully, ask about education benefits, and score every offer beyond base. Open enrollment is a raise if you run the math. Your paycheck is bigger than salary. Stop letting the boring screen keep the difference.